Jay Powell talks and nobody moves. The Fed decided to hold rates steady. Not a big surprise, but there were a few dingers that came out of the press conference, and we're going to tell you all about it and break it down so that you're prepared for the markets tomorrow. Welcome, everyone, to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and I am joined by my friend and co-host, and he's very tan, Tobin Smith out in sunny Scottsdale, Arizona. And you can't tell me it's not hot, Toby. I know it's hot.
Compared to you guys, I'm African American. Okay, I mean,
well, you're looking sharp.
I mean,
look like Bianco
has got to get out of the office at some point in time here. I mean, he's got the Chicago tan, I guess is what we used to call it back in the day.
Hey, it's 81 degrees in Chicago today, so yeah, let's get this going, and I'll get out of the office.
that is tropical. Well, as everyone knows, we do have Jim Bianco with us today, and he is the president of Bianco Research. He's in Chicago, Illinois. And Jim, I'm going to start the show off with you because all the talk is about the Fed, about what Jay Powell talked about. He even talked about politics, even though he didn't really talk about politics, but we'll talk about that later on. But my question for you is, do you think that Fed rate cuts are out of the question for the rest of the year?
At least until the end of the year. I think for the next 3 meetings, they're done. So that would be the June 12th meeting, the July 31st meeting, the September 18th meeting. I don't think that we're probably going to see any rate cuts. November 7th or the December meeting, could we see a rate cut? If the data slows. What he made it clear is that the Fed needs confidence. We're on our way to 2% inflation, and they don't have it. So they're going to need slower data. They're going to need things to weaken in order to reintroduce that. Ironically, just so you kind of know where everybody was thinking, the thing that kind of, got the markets going was when he was asked, are you considering rate hikes?
Yeah.
And he said, no, because we think we're restrictive. And it's like, whoosh, there's going to be no rate hike. And the market rallied on that.
That was the algorithm that when it took the market up 400 points. Was that one.
Yeah, so that seemed to be the thing that, got the market going there for a while before it reversed here towards the end of the day. But right now, it's higher for longer. There's nothing to talk about. If Friday's payroll report is a massive beat or a massive miss,
it looks like it might be.
Maybe, but if it's somewhere in line, what I'm trying to say is if this data is somewhere in line, we're on hold. And that seems to be what the answer is. But don't worry, if the data stays a little bit strong, he's not going to introduce the H word, the hike word, to the equation right now.
It was a little try to make everybody happy. But I'm still looking, primarily at employment, because he, in this talk and other talks, he's more than most Fed chairmen who really said dual mandate, full employment, price stability. And I was interested in the JOLTS numbers, and then I was really interested in the quit rate. The quit rate is dropped here in about 11% in the last month over month. And what the quit rate says usually is, hey, I'm quitting, I'm out of here because I got 3 other job offers. When you start getting lower quit rates, and I know that they value that because it's irrespective of any decade that's been sort of the same number or indicator, I should say. Then we're looking at service jobs. I was just with friends in California who are in the fast food restaurant business there. How would you like to be them with the $22 an hour rates and so on and so forth? And then the Starbucks number. Starbucks, our little local Starbucks is on our bike ride around the area. We always, bike riders, you always see a bunch of bike riders stop at the Starbucks, right? Last week, there was like 3 people at the Starbucks on Sunday at 11 o'clock. That was so highly unusual. This is a affluent, semi-retired environment up here in North Scottsdale. The fact that they were,
it's keeping people away.
I used to get my auto refill, Jim, on my Starbucks card, and it was like $25. That gets me like 2 Starbucks. So I raised it to $50 because I'm a big spender. but what I
You gotta
just
go
use
tall instead of grande. Pretty
yeah,
soon.
no, I don't go the whole. I don't go the mente, whatever that thing is. I can't remember. But it's the little things of behavior that change that intrigue me more, and about because we can't do anything about the 42% shelter cost, for God's sakes, after a pandemic with 2%, 3% mortgages existing. The average mortgage in this zip code rate is 2.8%. Why anyone would sell their house to go get a 7% mortgage and essentially double their monthly cost just simply on interest rates, not even if it was the same cost of home.
Yeah.
We have
especially because the price is not giving. You would expect that the price would be giving. So yeah, the only people that are trading on homes right now are the ones that have to. And that's why what you're seeing is that weird dynamic where prices are staying strong, but volumes are way down.
Yeah.
So it's only the ones that have to trade, and then they get full dollar for it that trade. So yeah, and as far as what you were talking about with behavior in the market, behavior because of the economy, you see that too in a lot of the data. If you look at the political polls, the president's approval rating is down. When people are asked why they're so glum, they yell about inflation. But then you go look at the economic data, and it's the inflation number's a little sticky, but the economic data is roaring ahead. And the president's trying to say, look at the jobs, look at the GDP, look at retail sales.
Look at salaries.
Everything's doing great. But what they're missing is the top 50% of income is 70% of consumer spending. And the top 10% of income is like a third of consumer spending. So it's all rich guys that are spending all the money that's keeping the GDP up. The bottom half is just suffering from inflation. Now, you could argue that's always been the case with the economy, but we haven't always had 3 or 4% inflation. That's what's different, say, than 2019.
Todd, Bianco's is on my economics kick.
Yeah.
How the hell can people make the comparison between a 1970s economy and a 2025 economy, especially when my thing, and Todd's heard us a million times, his ears are bleeding, but these 66 counties in the United States that account for 74% of the entire GDP. And what people send nasty notes to me and said, well, don't we count? I live in and we have 12 kittens and a chicken and stuff, but we count too. And I say, ma'am, I love you to death, but from a statistical data standpoint,
exactly,
if I'm going to make a forecast, it is going to be on the top 10%, the top 25%, and the top 50%. Because unfortunately, and the one I think, Jim, that I think people miss a lot is that the bottom 50% of households ranked by income only have 3% of wealth in the United States.
Right.
Now,
and they have over half the debt. They have
over the debt. They have 80% of the credit card delinquencies, because that's the only thing we're getting that's really delinquent. Right. And it really explained to me as I got into that and went back over the last 2 years, 3 years, why we have a certain group of human beings in the United States who feel slighted, anger, pissed off, neglected, not listened to, and know that they don't have a pot to piss in and the power to make a change, and they're frustrated, they're angry, etc. And if somebody, steps in politically and says, hey, what we're going to do, what choice do they have? I understand
2016.
Yeah. I mean, so it is a more than any time, even maybe the 20s, Jim, a have not type of disbalance, and that works in the political
I'll emphasize, you're right. They have about 3 or 4% of the assets, the bottom 50%. Top 10% have half the assets. They have over half the debt. They have most of the credit card delinquencies. Wasn't that true 10 years ago? Yeah, it was. But the difference was 10 years ago, when you had 1.5% inflation and they were getting a 1.5–2% raise, they could, to use the tennis metaphor, they could hold serve. They can
Yeah.
at least hold serve. But now if they're getting a 2% raise in a 3 or 4% inflation world,
Yeah.
they're not holding serve. And that's why the anger is coming. And that's
Yeah.
what's different about this economy.
Yeah,
I
I
used
agree
to-
with
Now, the
that.
top
You know-
half, we get that 3% inflation, but we just say some choice 4-letter words and we fill up our car and we move on. They have to make a choice. And that's really what the problem is.
I used to, Todd, I used to at Fox for like going to lunchtime because there was a Starbucks there and there was there were multiple fast food around Fox. And you could almost have a barometer, Jim, of how big the line was, at one of the sandwich shops, the Subway shop, based on how the economy was doing.
Yeah.
And how inflation was doing. I have a favorite place down here that's not that place, but it's called the Sourdough Inn, and they make the world's greatest sandwiches with fresh sourdough. And I just happened to pick coming up yesterday, coming back from a client's office, and I gave him like $20. He says that'll be $24, Toby. I was
crazy.
like, did I put extra cocaine in there or something? I mean, what exactly? How did this? And he says, let me,
Yeah.
I know you're that money guy. I'll show you why. Including that his rent went up. It escalated based on blah blah blah. So it is a standoff, and inflation is going to be stickier for longer because the components are different than it used to be.
Yeah.
Right.
And why we haven't come up with a new sort of what do they say, Jim? When the facts change, I usually try to change my opinion.
Right.
The facts have changed. The underlying aspects have changed. Forget about the fact that 10,000 people turn 65 every day till 2032. 5,000 turn 70. You also, I think, leave out the 73 million American households that have some form of a monthly pension. Now, maybe that's not keeping up with inflation.
Yeah.
But it's keeping them spending because they got this, that, and so on and so forth. And probably the wife worked for that generation where in the past they didn't. So we have these areas of extreme strength, prosperity lines, but that's not actually the average American experience right now, and that to me is troubling.
Okay.
Yeah.
Jim, the last time you were on Buy, Hold, Sell, you talked about the consumption basket, how the economy was continuing to roar and grow, and it wasn't showing any signs of a weakening, which would then really give justification for rate cuts for the economy now. And I know you talked about rate cuts possibly at the end of the year, but what about for the overall economy? It doesn't seem to be slowing down at all, at least in what we saw in the end of first quarter and then well into the second quarter. Do you see growth at 2.5%, 3% this year, or do you see any slowdown at all in the foreseeable future?
No, I don't. I mean, the economy growing at 2.5% would be potential or full growth for the economy, and largely because I will take issue with what Powell said, that he thinks that rates are restrictive at 5.25 to 5.5 on the funds rate now for almost a year. Restrictive to what? The stock market, the economy, jobs were still under 4% on the unemployment rate. Initial claims were still, in the low 200,000s on that number. What is being restricted, Jay, that is actually telling us that this number is hot? So that's why the economy continues to move forward. As far as the consumption basket goes, what I argued about the last time I was on was, you hear people, Paul didn't say it at this presser, but talk about the economy normalizing, getting back to normal. What's abnormal about it now?
What's abnormal?
What normalizing means is that we're all going to go back to the office. It's all going to be 2019.
Yeah.
No, that era, that's a different economic era. That era's over. We're in the post-pandemic era. By the way, it's different. Different does not mean worse. It means different. And because it's different, our consumption basket has changed. And I think that this is really what a lot of people are struggling with. So when they look at high credit card debt, a lot of spending, people won't stop doing that. That's this cycle. What will stop them doing it is a recession.
Jobs. If they lose jobs.
There was an economist at the Fed, Rudy Dornbush, and he had a great line that Bernanke used to use a lot. that an economic expansion does not die of old age. It's murdered. And what murders it? Oil prices, suffocatingly high interest rates, a financial crisis like a stock market crash, geopolitics like 9/11 or a pandemic now. You could throw on the list like from 2020. Those type of exogenous events come in and they break the economy. We're spending, the conference board said that they do a survey, and one of the things they do in their consumer surveys, they ask, are you planning on taking a foreign vacation in the next 6 months? I assume they don't mean New York City when they talk about foreign vacation, but it's an
Well, you can
record
always
high.
go to Brooklyn, for Christ's sake. All right. That's it.
Right, right.
Or go to Williamsburg and get your Russian dictionary out.
Right. But it's at an all-time high. And people say, oh, but that will slow down. I'm like, no, it's not. It'll slow down in the next recession. And when something murders the economy, we have a recession, then things change again. And we'll see what we have coming out of that. So this economic expansion will be one of strong growth, strong spending. Oh, that sounds good, but higher inflation. That's going to be your cost. And how long will that last? Until we have the next recession.
Yeah.
What will be the next recession? A spike in oil prices, suffocatingly high interest rates, some exogenous political event or something.
Okay, you used exogenous 3 times now, Bianco. That's it.
Okay.
The limit for exogenous.
All right. I'll go endogenous next.
Endogenous, right. All right. I would also add that I think a piece that the people are missing about the economy, they yell and scream about, immigration. But if you look at the jobs that are being taken in these major 66 counties in the United States that employ 72% of the people and generate almost 80% of GDP, you can, my friends who are in the landscaping business out here, they're having no problem getting employees, and they're paying very good wages. They, check their Social Security card like everybody's done for 40 years and close their eyes. But the amount of immigrants and legal immigrants, by the way, because after a while now, actual legal immigrants are in the workforce now. We didn't have that for a long time. We just didn't have that. And so at the bottom level, in a 72% service economy, last time I checked, these people are doing services. And as people tap out of the economy, they're tapping in, and they're hard to measure.
Yeah.
But we know we're seeing it in these steady rates.
Okay.
Yeah,
I see.
It's real hard to measure because a lot of the illegal immigration, they need to get a work permit in order to get a job, to get a W-2 job, that is.
Yeah.
They can always get, an under the table paid job.
Day labor.
And those are very difficult to get right now. So it is, the point being, those 7 million people, migrants that we've gotten in the last 3 years, how's that impacting the labor market? Even Paul was asked about it, and he kind of hedged on the answer, and I understand why. Because if I had 40 PhDs here and we looked at it, we would say, man, I just still don't know how it's really impacting the economy. It's so new, it's so different, it's so difficult to figure it out.
Go outside my house, Jim. Like 10 minutes ago, there was 15 dudes with blowers and so on and so forth.
Yeah, but the key word I said was W-2 income.
I understand, but there's a lot of W-nothing income out in that part of the United States.
Yeah.
And these guys work their, asses off. And when it's 115 degrees, the white folk are saying, I'm not going out there. These guys will go out there and do it. So that underground economy, on my experience, growing up, started in California and then being in DC and now being in Scottsdale. And then, I had a job in Texas. I don't tell many people that. But
do you live anywhere that's less than 100 degrees?
Look at this. Hello. No. And I didn't even go skiing this year. Usually I get this from 5 days of skiing. But there are some factors that are not W-2 factors, that aren't, don't have a spreadsheet behind them, that are keeping this thing going.
Yes.
And we've never had all of these things happen at the same time as, 10,000 people turn 65, 5,070 every day till the 231. There's so many things we never have had. And then coming out of the pandemic. I mean, this house used to be bare before the pandemic, and then I'm just on Etsy every day, buying shit. Right?
Right. Oh, yeah. Just to reiterate, I didn't say that it didn't matter. It's there. It's impacting the economy. We just can't measure it, and we're not exactly sure how it's impacting, but it is definitely there and impacting the economy.
Okay. I
There
like
should be a
it.
sound ordinance just for blowing air blowers, leaf blowers.
Right.
Today we had 435,000 leaf blowers going. Okay, that means the economy's doing pretty well. That's my fun.
That estate, Jim, that Toby has is just out of control, humongous out there in Scottsdale. He's got
leafy
1.5
trees.
workers.
He's got leafy trees in Scottsdale. That tells you right there.
Hey, hello.
I can only imagine what the water bill must be to keep those trees alive in Scottsdale.
Even Joe Biden doesn't have that many ground. So, all right. Well, listen, we're going to leave it there on that block, guys, because coming up next, I want to talk about what we heard from Jay Powell, which was the political side. He was asked the question about it, and I thought he gave a very nice answer. But I want to see what your thoughts are and see if it's if you really.
I want to know where Bianco says, "Did we have a bottom in this sell-off, or we have more pain to go?" Come back.
And we're going to talk about that too, Toby. That's right. Good keys right there. So listen. So with us today we have Jim Bianco of Bianco Research, and of course Tobin Smith and myself. We'll be right back after the break. Please stay with us.
Ready to up your game and learn more about the thrilling world of sports betting? Introducing Double Down with Breslow, the ultimate podcast about the business of sports gambling. Join me, James Breslow, and a long list of expert guests as we dive into the art and science of the sports betting industry. Evolving regulations, technology enhancements, and the meteoric rise in the number of players makes this sector the fastest growing and most intriguing in the world. Unlock the business secrets from many of the industry's most recognizable C-suite executives, including famous odds makers and influencers. Every episode of Double Down with Breslow is packed with insider tips, deeply skilled analysis, and in-depth discussions. Don't miss out on the ultimate resource for mastering the business of sports betting. Listen to Double Down with Breslow on the Evergreen Podcast Network or wherever you listen to podcasts. That's Double Down with Breslow, the business of sports betting podcast.
Welcome back to Buy, Hold, Sell. With us today is Jim Bianco of Bianco Research out of Chicago, Illinois. And obviously we have Tobin Smith with us as well, but as the co-host. But I got to say, Toby, you brought up a really good point before the break where you're talking about the down market in April and where do we stand right now, especially now that the Fed does appear to be on a pause mission as far as for the foreseeable future when it comes to interest rate cuts. But Jim, what do you think about this market? You had an S&P that was down over 4% in August. We hadn't seen that kind of decline since last October. And you had 10 of 11 S&P sectors that took losses as well. Is the bottom here, or are we going to see a little bit more selling?
I think if I had to guess, we're going to see a little bit more selling. And I'll tell you why. You mentioned October. From July to October last year, the S&P corrected 10%. What also happened from July to October last year? The 10-year yield went from 3.80 to 5%. You know, for most of the beginning of the year, people kept saying interest rates don't matter. And then they went through 450 on the 10-year note, and then they seemed to matter. So I think that the yield move, you know, we're at around 465, 470 as we're recording, up from like 390 at the beginning of the year. I think most of the move is behind us, but I still think we're going to go to 5%, or maybe a little bit more, 5%. And that's going to be a big headwind for this market.
Why are we going to 5%?
Because the economy's strong, inflation is sticky, and more importantly, if you look at all the surveys and everything, everybody in bond land started the year long.
Yeah, now they're
long, and now they're capitulating, and they're going to capitulate us to 5%. And why is 5% a problem for the bond market? I mean, for the stock market, excuse me, is because it's 5%. There is an alternative. It's not a T-nut market anymore. Dr. Jeremy Siegel did an update to his book, Stocks for the Long Run. In the update last year, he said he projected, you know, with price earnings and everything else, what should an investor expect the stock market to give them over the very long term, like a decade? About 8% a year. Okay, that sounds reasonable. I could get 5.3 in a money market fund right now, and the Fed is on hold. I could get 70% of what the stock market is offering me with a $1 NAV every single day. In a bond fund, I could get 5%.
Risk-free and a $1 NAV.
Right.
Schwab,
What does a higher interest rate mean for the stock market? Older people that'll look and go, I'll take the coupon income. It's most of what the stock market's supposed to give me with a lot less risk. That's where the competition comes in. That's why as rates go up, the stock market seems to struggle. That's what happened July, October last year. And it seemed to start the day after the CPI report 3 weeks ago when we hit 450. We hit 450 in the 10-year note. We kept going. All of a sudden, the stock market looks like it's a smoker trying to run a marathon at that point. You like that?
Yeah, I mean, I think the people home sort of, missed a couple big points here because it's pretty esoteric. But as interest rates go up on a bond, it goes down in value. The reason why a coupon 5%, if there was such a thing, 10-year, if rates went to 6%, that would mean that 10-year was down 20% in value. So if you're the big money in this world, and as much as I'd like to say that we're all the big money here, the people who are the last 10 minutes, you saw that, Jim, the last 10 minutes of the market now in the indexes is now 70% to 80% of all trading. In the bond market, and the bond market is a complete reversal. In the bond market, the guy who runs the big pension plan has got this layer of bonds that he owns or she owns, and there can be a move, just a little move, that upsets his or her apple cart. She sells it. Well, as soon as you get enough of those pension plans to sell during the day, bonds are not as liquid, ladies and gentlemen, as your freaking ETF SPY. And I've been on trading desks, the old Salomon Brothers guys, because they were the bond dudes. And you would see, and this is like before freaking, you could send a text. Everybody had to be on your Bloomberg, but you could just see the fear when you see something jump up like that. They knew that their bonus for that month was going to get hit because the valuation was going to go down, and then we'd have to blah 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 sell. So they sell first many times in the bond market, and then think about it later. And no one realizes that the bond market is 3 times bigger than the stock market, Jim, or 10 times?
Yeah.
I can't remember.
Yeah, it's the largest. It's the largest asset market in the world, the bond market.
Yeah, and that's not even counting what China's doing, Japan's doing, Saudi Arabia's doing, everybody else who owns those 10-year bonds.
Toby, just to throw out one other thing too, is that you mentioned that, like 70-80% of the stock market's trading at the end of the day. And now we've seen a new phenomenon, if you remember last week with Meta and Alphabet and Microsoft, that most of the move comes after the close. And I was talking to a friend who wasn't involved in the market. He goes, wait a minute, how does that work? Your market closes and then you get all the move? It's like a retailer saying, I sell all of my stuff after the store closes. Right. It's like, well, there's a close and then there's the close. Yeah,
70 to 80% of all stocks are algorithmically traded.
Right. And the day we're recording tomorrow us is Apple's earnings. So if you're a stock trader, your day begins at 10 to 4. Because then you'll get 80% of your trading, and then you'll get all your move depending on what Apple does. And then in 2 weeks, we're going to get NVIDIA, and we'll do it all over again.
Yeah.
Hang on. I do this when I hear the word NVIDIA.
Well, it's interesting. I remember we had Katie Stockton on Buy, Hold, Sell, and she said that she had predicted or forecasted a 5.5% 10-year this year. And naturally, when you saw bonds rally and you saw rates dropping, she just really that prognostication didn't seem like it was coming true. Now all of a sudden it is, and now I'm hearing from you, Jim, and it's amazing when you start thinking about these numbers, because if rates do continue to move higher, what's that mean? And I know we're not a political show, but it does have to have some type of reaction to what's taking place in November with the presidential election. I mean, what do you think of that statement?
Yeah, absolutely. And I'll distill it for you. As we talked about in the previous sector, 70% of spending is the top 50% of income. Jeff Bezos' spending is 1 million times what somebody in the bottom 50% is. He just bought his third $90 million house last month. He's got more $90 million houses than he can remember at this point.
Yeah.
And so that's why the economy continues to move. Well, if you give those people at the top end 5.5% on the 10-year note, they're like, sign me up. That's just more interest income. But if you tell the bottom half 5.5%, that's more interest expense for them. And so that's why interest rates will become highly political. And let me give you one other one. The Fed, in their announcement today, also announced that they're going to reduce the amount of quantitative tightening that they're going to do.
Explain what quantitative tightening is, because it sounds to me like a baby, putting a diaper on or something.
That's pretty accurate. So what it actually is, the Fed has a $7 trillion balance sheet. They own $7 trillion worth of Treasury securities. So every month they have about 100 or $200 billion of those, or I should say of bonds, because they own more than just Treasuries. They have 100 or $200 billion worth of those bonds mature every month. What do they do with the 100 or $200 billion? They reinvest it back into the bond market, less $95 billion. So that's how they reduce their balance sheet. They just buy less when they mature. Well, they're going to start monkeying around with that, and they're going to start changing the numbers that they're going to do, reducing the numbers they're going to do in Treasuries, but they're not going to touch the mortgage numbers. And some people have speculated, and I think they might be right, the Fed's afraid of those mortgage numbers because they're the biggest they're the biggest player in the mortgage market. And if they start playing around with that mortgage number, they'll be blamed for mortgage rates. You can move interest rates. That's an abstraction, but man, oh man, if you're in charge of higher mortgage rates, you are the enemy number one in the public.
Well, also it goes through credit cards, it goes to auto loans.
Right.
So
but nothing gets people's emotions like a mortgage rate, and stuff. And so, Todd, you asked about, the Fed being political. And I like to use the line that I got from Claudia Sahm, the economist. The Fed is, and this is the way Powell answers the question every time. I am on board that the Fed is not partisan. They don't sit around the table going, do we want Trump or do we want Biden, and which policy gives us the guy we want or don't want? They don't do that. And I agree, they don't do that. And that's what Powell stresses. But are they political? Do they know that the July 31st FOMC meeting is between the Republican and Democrat convention? Yes. What do they want to have between that and the September 18th meeting during the political season? They don't want their name mentioned. They want to be Homer. Yeah, they want to be Homer Simpson fading back into the hedges. If you move rates at the July meeting or the September meeting, you become the focal point for Biden and Trump to talk about for 2 weeks. So yes, they are political. They're not partisan, but yes, they absolutely are political. And, so when Powell answers that question, are you political? He's actually answering the I'm not partisan question. That I agree with.
Good point.
I mean, the sort of boiling, a lot of it, because, the bond market is still the craziest thing I've ever. I started in the bond market. It's gotten 100 times crazier because it controls everything, but no one knows who it is. Who is that bond market?
Because it's not controlled by anybody. It's controlled by a bunch of computers, and
Yes, exactly. So, but the point here is that there's two other ones. One is, first off, a hidden part of this earnings per share that has been happening in the big companies that are sitting on a lot of cash is they used to get 25 basis points, a quarter of 1% on their cash, and now they're checking they're getting 5 to 6% yields on their corporate money market accounts. Well, that's real money when you have when you're Apple and you have 100 billion of cash. Do that math. That goes all to the bottom line. It's an earning. You got to recognize it when you earn it. So it's this tail. It's the sword that goes both ways. For the companies with a lot of cash, that's why the big have gotten bigger. In my opinion, that's why the valuations have moved, because they have such efficiencies of scale. They have such efficiencies of distribution. They have such incremental new profit margin things they can add, and then throw everything else on it. They're getting $50 to $60 billion of freaking interest that they never got in the last 12, 14 years.
If you look at the data from the BLS, they put out data on net interest expenses, non-financial corporation net interest expense, and I'll bottom line it for you. The rise in rates has not really crimped a lot of big, well-established companies
I don't know.
because they're getting more in interest income on their cash than they are paying
Right.
out in expense. Now, the zombie companies and the lower end companies, it's a little bit of a different story there. But as far as, the Microsofts and Berkshire Hathaway and a lot of these big companies, are they being punished by higher rates? No. Warren Buffett's sitting on $130 billion of cash. So Jay keeps raising rates, and Warren is now making another $8 billion a year for Berkshire Hathaway on his cash that he wasn't making 4 years ago. So this is not necessary. This gets back to what we talked about in the earlier section, right? Are interest rates restrictive? What are they restricting, Jay? Are they restricting the stock market? Are they restricting the economy? Are they restricting the labor market? I don't see it. I don't see where they're restricting anything right now. Are they restricting Warren Buffett? No, he's getting more interest income off of all of his treasury bills that he owns.
Yeah.
So
Yeah. I mean, it's just a fact of life, damn it, that 61% of the households only account for about 21 or 19%, depending on how you do with GDP. But more importantly, when it comes to discretionary spending, because at the margin, that's where you get the next level of growth. The bottom 50% literally account for about 4% of all discretionary spending. Almost all discretionary spending, as in, geez, I just went out and bought a new iPad, or I just this or whatever, is being paid for mostly in cash or in credit card that gets paid off at the end of the month.
Yeah, and not only that, the bottom 50%. If you go to the bottom quarter of the country, about 80% of their paycheck is on 3 items.
Yeah,
it's on housing, transportation, and food. And food usually means the grocery store, where on the top end, food means the restaurant. So that's 80% of what they spend their money on. And they don't have any money to begin with. So whatever the other 20% is, so that they could go apparel and everything else, they don't have a whole lot left for that.
And we're not crapping on the lower end. I guess we seem insensitive. And
I don't think we are. I think we're explaining the plight that they have.
But
and that's why things like food and energy matter a lot to them. Because that's the bulk of what they're spending their money on.
Yeah.
Yeah.
And it's it can be very sad. And I think, again, we're talking about I've been in every state in the union. I've learned so much about America, by meeting people in Valdosta, Georgia, and Birmingham, Alabama, and Missoula, Montana, and, so on and so forth. We're a nation of great people, hardworking for the most part people. But the world changed in the 50s, and then it changed again in the 80s, and now it's changed in the 2000s in terms of where you add value to the economy.
Yeah.
And Jim and I can leverage ourselves by selling research and being consultants, and there's 5 things: write books, and we have 5 or 6 different ways to monetize our skill set.
Yeah.
If you don't have that, you have one way to monetize your skill set. It's called a paycheck. And if it's in something that has lower value relative to the rest of the world, and the prices for your things are going up at the same time that you have no control about, it would explain a lot of why so many people are just so pissed off.
And add into that unease. There's a professor at Northwestern University up here in Chicago, Bob Gordon, and he's written a lot about technological change. I know Bob, known him for a long time. And what he says is that technology is a net creator of jobs. It creates more jobs than it destroys. The problem is
the but
when a new technology comes, AI, everybody can see the job it's going to destroy. Oh, we're going to have autonomous cars and we're going to lose 12 million jobs. There's 12 million people in the United States that have a job called driver. Those jobs are going to get eliminated by autonomous cars. And we're all worried about it. But as Bob would say, yeah, but it'll probably create 20 million jobs because we got rid of drivers and we've lowered transportation costs.
Yeah.
And then he'll go on to say, well, what are those 20 million jobs? And you go, I don't know. They haven't been created yet, but they will be. Well, that's not good enough. We're going to lose the driver jobs, and that's bad. And so therefore we got to put up rules to stop this stuff. This happens with every technology that we have. And so we're in the precipice with AI of a technology could be as monumental as the internet itself. It will be a net creator of jobs. There will be whole new industries that don't exist because of this technology. But
Yeah.
getting there is going to be a little bumpy. And yeah, lower end jobs that can be automated away, like automated driving, to use one example, are going to happen. We're already seeing it with kiosks at fast food restaurants. Half the jobs in the United States that pay minimum wage have the same job title, cashier. And that job is being automated away by kiosks and mobile apps and everything else, that we're getting rid of the cashier. And that is scary because of this technology. What are we going to do with those people? There will be new jobs that will be created.
But there will be new jobs. You just can't name it right now. On the other hand, if you don't live in the right part of the world, and you certainly don't have a skill set, you can't walk in as a zombie into a whole new AI post-revolution and not upgrade your skills. But thankfully, there's this thing called the internet. My español es muy perfecto, fantástico, pero there's this thing called Duolingo. You used to go hire someone to, come by your house to teach you, Spanish. Now I get it much better and get feedback off Duolingo for, $9 a month. So there was some translators who lost jobs, but those translators went on to do other stuff. So, all right.
Yeah.
The example he used, the example that Gordon used, that you mentioned, VisiCalc. When the spreadsheet came in, there was in the early 80s a worry that there was a lot of jobs that were called accounting clerk. The people that would fill out spreadsheets by hand, and we were going to get rid of a lot of those jobs. And we did, because of the spreadsheet. But we created a new category called financial analysts. Now I could do something with these numbers. We actually created more of those jobs than we actually got rid of the accounting clerk job. We got rid of telephone operators. But once we went to automatic phones, it opened up the world of telemarketing and everything else, that we created far more of those jobs than we did getting rid of operators. But again, in the early days, you could see the technology gets rid of the telephone operator, but I don't know what's going to come after it. I could see the spreadsheet gets rid of the accounting clerk, but I don't know what's going to come after it, but something does. Something always does. And that's what is so scary about. I can't tell you what the new career jobs are, but I can see the jobs that will be eliminated.
Well,
and ladies and gentlemen, we'll be sending you your Economics 101 certificate, because you now know everything you ever needed to know about it.
It's very promising. One final question, Jim, before we let you go. The jobs report on Friday. Bloomberg consensus is looking at 240,000. You saw the ADP number come out. That was a beat. What's your number? Will we beat, or will it be a disappointment on Friday?
All right, so to preface it, we've been getting beats. It was 303,000 last month, and we'll see what the revision is. We've been getting beats the last 4 or 5 months now, consistently, not only in payrolls, but in a lot of the other data. I will go with a beat, because that seems to be the trend that we've been seeing in this data. We've not seen anything in the employment data, as you mentioned, ADP, although that's kind of got a spotty record, beat. The initial claims numbers are not ticking up. We've saw some good numbers in the ISM employment statistic as well too. So I'd probably go with a beat. What does a beat mean? Just reinforces the idea that we're months away from a rate cut, only if the data starts to slow. There will be no rate cut probably between now and the election, unless something catastrophic
And in my
happens.
mind, that the Maginot line, if you will, is jobs, because they know now they can cut the rate, and it's not going to create this huge spur, because we already I had this huge spur. Maybe it's going to make some housing turnover, but that's okay. But when the jobs go, and because they are political, I lived in DC for 32 years. Trust me, they may not be partisan, but they are political. If you start to see job deterioration, they'll do it just to be on the safe side.
Jim, what's your take on the jobless claims number? There's been talk that the number just doesn't change, and it's just statistically impossible.
Yeah, I've pointed that out too, that it, for 5 weeks in a row it was 212,000, and then it finally changed. It went to 207,000. There's 160 million people in the United States. At any given week, 1 million people file for, a million people turn over their jobs, 200,000 file for initial claims. You'd think there's 50 initial jobs are, unemployment insurance is a state program. There's 50 programs. with 50 different rules, 50 different websites. You'd think at least 1,000 people would fill out the form incorrectly every week in order to get some kind of movement in this thing. I don't know what's going on with that number, but I would like the BLS or somebody else to explain why it hardly ever moves from week to week. Look, maybe they're just not reporting it properly. You know, they've had, because remember, jobless claims, the BLS, in fairness to the BLS, they collected numbers from the 50 states, and then they just put a seasonal adjustment factor on it and they put it out. So maybe a lot of the states are not really filing or are not reporting to them correctly. That has been the case in the past. Famously last year, there was a big spike in Massachusetts initial claims, and people were trying to figure out what it was. And then they finally decided it was the Red Sox trying to get a new bullpen, and they fired all of their middle relief or something like that. But yeah, it's been a real shock, but nevertheless, it is a very low number. 200,000 is a very low number for initial claims. And it's not suggesting, at the very least, it's not suggesting there's a problem in the labor market. If it was, it would be 300,000 or 400,000. It won't go from 2.7 to 225. It'd have to go to 300 before you'd really start to worry that there's a problem.
Interesting. Well, we will see. We will see what happens. Well, that's going to be it for the show. Because I got to tell you, Jim, you always bring it. You always bring the best, and everybody gets a lot out of it when they watch this show. Which, speaking of, we just signed on with Dingo TV, Stir TV, and Avo
Dingo
TV.
TV.
Dingo TV. So, and which has Lacrosse TV actually.
Put one on the Bobby. Is that what we're talking about?
That's right. So we definitely want everybody to tune in and check out Buy, Hold, Sell. But Jim, I got to thank you for joining us. We always enjoy having you on the show.
Thank you, brother.
Can't wait to have you back. And thanks again for joining us today.
Thank you. Enjoyed it.
Absolutely. So, and for everyone out there, check out BiancoResearch.com. Check out what Jim has to say and what they have to offer. Definitely going to like what they have to write about.
Right. And if you have 10 grand a month, you can become a subscriber. So it's really good.
Wait, when did I cut my price?
I was going to say.
There you go. So on behalf of Jim Bianco and Tobin Smith, I am Todd Schoenberger. Thank you once again for joining us on Buy, Hold, Sell. We'll catch you next time. Take care. All right, that was...
Buy, Hold, Sell, brought to you by CrossCheck Management.
I want you to smash that like button.